Hey guys, welcome back to the Bitcoin Fortress podcast. This is episode 200. Today is January 25th, 2026, and we are at block height 933,760, Moscow time 1146, and fees are 1 sat per VByte on the low and the mid, 3 on the high. Quick vibe check. This week felt like institutional stress plus political theater plus minor reality, which is basically Bitcoin's natural habitat. Legacy finance keeps trying to design market structure with paperwork. Bitcoin keeps enforcing market structure with incentives. That's exactly what my Substack post is about. The real market structure is incentives, and we'll cover that, of course, as we always do, featuring one of my Bitcoin Fortress Substack posts at the end. So with that, let's jump right into the news, starting with markets and institutional flows. Bitcoin dips under 88,000 heading into Fed week and big tech earnings. This from CoinDesk. Weekend liquidity plus the macro calendar equals a Bitcoin slide below 88,000 in thin trading conditions. Weekend moves are truth serum for positioning. Low liquidity reveals where the stops and the fear live. Fed week is still treated like gravity, even in a Bitcoin world, because most participants still price Bitcoin like a macro risk asset in the short term. Bitcoin's volatility is the toll for escaping fiat debasement, so don't confuse volatility with failure. Now, if price is sagging, what are the institutions doing behind the scenes? Spot Bitcoin ETFs, worst outflow week since February 2025. This is from The Block. It was reported about $1.33 billion in weekly outflows. IBIT saw multiple days of outflows last week. ETF flows are not adoption in the moral sense. They're allocating decisions by allocators who are fickle by design. This is a teaching moment. Paper rails amplify reflexivity, which is something that we talk about a lot here. It enhances the price move on the way up when everybody's piling in, and of course on the downside when everybody's running for the exits, the institutions that is, or whoever's buying the paper Bitcoin. This is a healthy reminder, of course, that self-custody is the antidote to institutional mood swings. And while ETF tourists are coming and going, the loudest permanent buyer did what it always does. And that's, of course, Strategy, who bought $2.13 billion of Bitcoin in about 8 days. This from Reuters. Strategy bought 22,305 Bitcoin, or $2.13 billion worth, between January 12th and January 19th. Holdings currently reported around 709,715 Bitcoin as of January 19th. This is corporate treasury as a one-way valve. The market keeps trying to trade quarters. Sailor is trading decades. And even when the stock sells off, the signal is clear. Some players are opting out of fiat time. All right, ETFs wobble, Strategy accumulates, and the rest of Wall Street smells volatility. Galaxy plans a $100 million crypto hedge fund aimed at volatility. This from the Financial Times. Galaxy looking to launch a fund, reportedly about $100 million, to capitalize on volatility, mixing crypto exposure with related equities. Volatility is being productized. In bull markets, everyone is a visionary. In choppy markets, the pros sell dispersion plus basis plus relative value. Bitcoiners should hear this as more intermediaries will monetize your uncertainty. Scaramucci at Davos, volatility up, timing issue, not thesis break. And this also from Reuters. Scaramucci described macro volatility under policy uncertainty, said Bitcoin pullback is timing, not fundamentals. He noted regulatory timelines have not moved as fast as hoped. TradFi wants Bitcoin upside without Bitcoin's no manager accountability. The bigger point, regulatory uncertainty is a feature of transition, not a bug. Bitcoin doesn't need permission, but business models do. All right, moving on to regulation plus what we will call market structure theater. The big US crypto bill is on the move, what it means for users. This from CoinDesk. CoinDesk reported momentum and political dynamics around a major US crypto bill and why major industry players are split. This is the recurring cycle. Protect consumers, write ambiguous rules, carve outs for incumbents, enforcement by discretion, users get KYC'd into a database. So for the Bitcoiner angle, if the consumer protection product requires surveillance, it's not protection, it's control. The freedom takeaway is build and use tools that don't need legislative blessings. The Senate Agriculture Committee draft expanding CFTC authority over digital commodities. This is from the Lowenstein Crypto Brief. Updated legislative text described as granting the CFTC authority over spot cash digital commodity transactions with notable changes versus earlier drafts. More authority always sounds clean on paper. In practice, it becomes more reporting, more gatekeeping, more licensed permissions. Bitcoiners need to separate Bitcoin the protocol, rules enforced by nodes, versus Bitcoin the asset in regulated wrappers, rules enforced by agencies. The likely outcome, compliance costs rise, favors the big players, pushes small innovators offshore. And this ties directly into the featured Substack post because Bitcoin already solved market structure in the only durable way possible, and that is incentives. Moving on to mining plus network fundamentals, hash rate drop, and miner capitulation narrative. This from CoinDesk. CoinDesk reported hash rate down materially from a prior high and discussed difficulty adjusting downward amid miner stress. Miner pain is the honest heartbeat of Bitcoin. When margins compress, weak hands shut off. Difficulty adjustment is the underrated miracle. Bitcoin doesn't bail out miners, it reprices reality. It's a good moment here to remind everyone that the network gets stronger by forcing efficiency. And if you're home mining with one or two or three or four solo miners, it's an opportunity to win the lottery. As the hash rate drops, your odds, well, they go up. So good luck out there. Next up, Van Eck, talking about miners pivoting towards AI demand, hash and difficulty slipping. This from the Van Eck Bitcoin Chain Check. Van Eck noted mining activity trends lower, difficulty down, hash rate down, and framed part of it as miners reallocating power capacity amid booming AI data center demand. The AI versus Bitcoin energy narrative is backwards. The real story is energy buyers competing and miners are flexible demand. If AI offers better returns per megawatt at the moment, miners arbitrage. That's not weakness, that's capitalism. In the long run, Bitcoin mining becomes the buyer of last resort for stranded or underutilized energy and a grid balancer when priced correctly. Next up, hash rate index roundup, measurable network hash rate changes. This from hash rate index. And again, we'll put links to all of the articles I'm covering here in the show notes. Hash rate index reported week over week changes and moving averages, reflecting a downshift in network hash rate trends. This is your on-chain weather report. Price is always the headline. Hash rate and difficulty are the infrastructure story. Bitcoiners should track these because they tell you when the network is absorbing shocks. Moving on to Lightning and scaling reality. Research critique why two-party Lightning channels struggle with liquidity over time. This from Protos, citing Renee Pickhart's research. New research argued two-party channels structurally face liquidity depletion challenges impacting routing efficiency. Lightning is not set it and forget it, it's a liquidity network. The mature take isn't Lightning failed, it's the network is discovering its real economics. This is bullish for builders. It pushes better tooling, liquidity markets, smarter routing, multi-party channel factories, concepts. Consumer takeaway, though, is most users shouldn't be running channel ops manually. Wallet UX should abstract it like TCP/IP did for the internet. And I'll be honest, I haven't started running my own Lightning channel yet. May do that someday, but kind of waiting for the technology to make it a little bit easier to park some Bitcoin in there and not have to worry about getting force closed at high fees or whatever can happen to you, and earning a little bit of money on routing transactions. Stablecoins, geopolitics, compliance blowback is the next segment. A report talked about Iran's central bank using Tether at scale to bypass restrictions. So this was from The Guardian, referencing elliptic findings. Guardian reported elliptic's findings alleging Iran's central bank used significant USDT transaction flows to route around banking restrictions and sanctions. So, stablecoins are dollars with different plumbing, and that plumbing routes around choke points. So, expect a policy response. This kind of headline becomes justification for broader surveillance regimes that will hit ordinary users first and probably the hardest. Bitcoiner distinction, though, USDT is a centralized and censorable network. Bitcoin is neutral and harder to gate, which is exactly why it scares them. Tether pushes back their audit timeline again. This is from Blockworks. Blockworks reporting that Tether is pushing back the timeline for a full audit and leaning on attestations. Bitcoiners should be consistent. Don't demand, don't trust, verify for everything except the plumbing you use to trade. Stablecoin risk isn't just peg break, it's freezes, blacklists, banking rail constraints, and regulatory whiplash. So keep the stablecoins as transactional tools, but not savings vehicles, and keep your long-term conviction asset in full, secure self-custody. Well, that wraps up the news. Let's move on to the Bitcoin podcast themes of the week. There are several recurring meta themes that we'll go through. First up, of course, market structure, politics. Bitcoin's market structure is incentives. Again, this is a nice lead in to my featured post of the week. Institutional rails amplify mood swings, ETF flows, and volatility products. The ETF inflow-outflow narratives whipsaw sentiment fast. Minor reality check and difficulty adjustment as the silent hero. Hash rate difficulty stress shows Bitcoin's self-healing design. Lightning is entering its grown-up economics phase. Liquidity and routing constraints are being studied more honestly now. And finally, stablecoins are the next regulatory battlefield, geopolitics and audits. These headlines become the excuse for broader financial surveillance. Bitcoin Audible had fresh January drops touching on media fakery and CBDC incentives, which is good for the truth versus narrative angle. And Citadel Dispatch recent run has been heavy on policy plus protocol risk discussions, which is good for let's not outsource our thinking, shall we? Moving on to the featured Substack post, the real market structures, incentives, and Bitcoin. Bitcoin got them right. Again, link in the show notes. Bitcoin's regulation is enforced by participants with skin in the game. So miners spend energy or die. Nodes enforce rules or fork into irrelevance. Users secure their keys or accept losses. And developers can't force upgrades without consensus, which can be messy, but seems to have worked out pretty well over the years. We would contrast intentions-based regulation, though, versus outcome-based incentives. And you can lobby intentions, but you can't lobby thermodynamics. The laws of physics cannot be cheated. So, if you like today's episode, check out that post, share it with a friend who still thinks market structure is a committee meeting, and maybe they'll look at things a little bit differently. Did want to mention my 3 books that are out there available on Amazon, links in the show notes, all different formats available. Bitcoin Fortress, a simple guide for beginners. Bitcoin retirement and estate planning. And finally, the Bitcoin lifestyle. Also would like to mention my YouTube channel that I started. I also put a link in the show notes to that as well. Lots of short video content, trying to make it fun and entertaining, but also educational. And you can also find my podcast links there too, if you don't already subscribe on a podcast platform. Well, that was a short one this week. That wraps up episode 200, a significant milestone here at the Bitcoin Fortress podcast. If you've been here since the early days, thank you. Shout out to you. You're awesome. And thanks for being a regular listener. I really, really appreciate it and enjoy doing this every week. Remember this, the system runs on incentives, not speeches. So cut through the noise, zoom out. Don't freak out that Bitcoin isn't at $100,000. It's going to go up a lot more than that in the future because scarcity and because money printer go burr. Stay humble, stack sats, and I will talk to y'all next week.